Most Americans believe the S&P 500 alone will someday fund a comfortable retirement without financial stress or fear. But retirement is not about watching a portfolio number grow quietly on a screen for 30 straight years. Retirement is about replacing your paycheck every single month after your working years finally come to an end. And those are two completely different financial goals that most investors never truly understand until much later. A growing portfolio may look impressive while your actual monthly income still feels painfully small and unstable. That becomes terrifying once paychecks stop arriving and monthly bills continue showing up without mercy or hesitation. Groceries still cost money during retirement, and healthcare expenses usually become even more expensive with age and time. Utility bills continue arriving every month, whether the stock market feels optimistic, fearful, stable, or completely chaotic. Property taxes continue climbing quietly while inflation slowly chips away at the purchasing power of your retirement savings. Retirement is not scary because people stop working someday after decades of building careers and supporting their families. Retirement becomes scary because the bills never stop, even when your energy, health, and confidence slowly begin changing. And that fear quietly follows millions of Americans long before they ever officially reach retirement age or financial freedom. Many people spend decades investing faithfully into index funds without ever calculating the income those investments actually produce. They focus entirely on growing account balances while completely ignoring the paycheck their portfolio eventually needs replacing. That misunderstanding creates one of the biggest retirement problems quietly growing across America right now behind closed doors. The market may rise beautifully for decades, while retirees still feel anxious every time they open another monthly bill. Because a large investment account does not automatically create dependable income strong enough to support real everyday living expenses. And this becomes painfully obvious during market crashes when selling investments suddenly feels emotionally exhausting and financially dangerous, especially for retirees depending on those investments to survive through rising costs, inflation, healthcare expenses, and economic uncertainty. So before buying another index fund, there is something incredibly important most retirement investors desperately need understanding first. Tashvin. The S&P 500 is one of the greatest wealth building tools ever created, but it was never designed for retirement income. Most people hear stories about millionaires built through index funds and assume retirement automatically becomes easy afterward. But growing wealth and generating reliable monthly income are completely different financial problems requiring completely different strategies and expectations. The S&P 500 was built primarily for long-term growth, not for paying retirees dependable monthly income throughout retirement years. That difference becomes extremely important once your career slows down and your investments must begin supporting everyday life expenses. Right now, the average dividend yield of the S&P 500 sits around only 1.3% annually. That means a $1 million portfolio may only generate around $13,000 yearly before taxes and inflation. Broken into monthly income, that becomes roughly $1,000 per month from dividends before considering rising living expenses. For most American households, $1,000 monthly barely covers groceries, utilities, insurance, and prescription medication costs anymore, especially after recent inflation pushed the cost of food, healthcare, transportation, and housing significantly higher across the entire country. Many retirees discover this reality too late because their portfolio looked large enough during the accumulation stage of investing. But retirement changes everything because your investments suddenly become responsible for replacing the stability your paycheck once provided consistently. Imagine owning a beautiful, expensive home worth millions while having very little monthly cash flow available for daily living. On paper, you appear wealthy, but emotionally, your financial situation still feels stressful, fragile, and deeply uncomfortable every month. That is exactly how many retirees secretly feel while depending entirely on growth focused portfolios during unpredictable market environments and downturns. And the danger becomes much worse during bear markets when stock prices suddenly fall while bills continue arriving relentlessly. Selling investments during market crashes often feels emotionally painful because losses suddenly become real instead of temporary paper declines. Many retirees panic after watching years of savings shrink rapidly during recessions, inflation spikes, or major economic uncertainty periods. Some reduce spending dramatically while others return to work simply because their portfolio income no longer feels emotionally reliable anymore. This is why retirement investing should focus not only on growing wealth, but also on building dependable growing income streams. A strong retirement portfolio should continue paying income whether markets feel optimistic, fearful, flat, or temporarily falling apart completely. because monthly bills do not care whether the market is experiencing a correction, recession, recovery, or another historic bull run. And retirees deserve a financial system that feels stable enough to support peace of mind during uncertain economic periods ahead. A portfolio can absolutely look rich on paper while still leaving someone emotionally stressed about ordinary monthly living expenses. That is why blindly buying the S&P 500 alone may not solve the retirement problem most Americans actually face. Tash Pan, once people realize the S&P 500 produces limited retirement income, many immediately begin searching for higher dividend yields online. Suddenly, they start chasing investments promising 7%, 9%, sometimes even 12% annual dividend income payouts. And at first glance, those numbers sound incredibly attractive to retirees wanting larger paychecks from smaller investment portfolios quickly. Because naturally, people assume higher yield means more income, better retirement security, and faster financial freedom with less invested money. But extremely high dividend yields are often the market's warning sign that something underneath the business is seriously wrong financially. Sometimes the company's profits are shrinking while management continues paying unsustainable dividends just to keep investors temporarily calm and hopeful. Other times the stock price collapses rapidly, causing the dividend yield percentage to appear unusually large and dangerously misleading. That is why many high-yield investments quietly become retirement traps instead of stable long-term income solutions for aging investors. A massive dividend yield can sometimes resemble a clearance sale that experienced investors quietly avoid for very important reasons. Imagine seeing a luxury car suddenly selling for 80% below market value without understanding why everyone stopped buying it. The low price may look exciting initially, but hidden mechanical problems often explain why the discount became so extreme. The same thing frequently happens with extremely high yield dividend stocks attracting desperate investors searching for fast retirement income solutions online. Many retirees discover this painfully after buying risky income investments that eventually slash dividends during difficult economic conditions or recessions. Suddenly, the income they depended on disappears while the stock price continues falling at exactly the worst possible moment financially. That emotional damage often destroys confidence because retirees feel betrayed after trusting investments promising stability and dependable retirement cash flow. This is why intelligent dividend investing is not about finding the highest yield available anywhere inside the stock market today. Instead, successful retirement investing focuses on finding businesses capable of growing dividends consistently for many years into the future. A smaller dividend growing steadily every year often becomes dramatically more powerful than a larger dividend remaining completely stagnant forever. Because retirement income should ideally grow alongside inflation instead of slowly losing purchasing power every single year after retirement begins. The real goal is not building the biggest paycheck today, but creating the safest growing paycheck possible for tomorrow. TalkFen. Most retirees are not dreaming about private jets, luxury yachts, or impressing strangers with extravagant lifestyles during retirement years. What most people truly want is the ability to sleep peacefully without constantly worrying about money running out someday unexpectedly. They want groceries covered comfortably without checking bank accounts nervously every single time they walk through supermarket checkout lines. They want utility bills paid automatically without feeling stressed whenever electricity prices, insurance premiums, or healthcare expenses suddenly increase again. They want enough dependable income to enjoy ordinary moments without turning every financial decision into another exhausting emotional calculation or sacrifice. Because retirement is not really about becoming rich enough to impress people who barely think about your life anyway. Retirement is about removing fear from ordinary mornings and creating stability during a season of life meant feeling peaceful instead. Unfortunately, many investors accidentally build portfolios designed only for growth instead of emotional financial stability during retirement years ahead. They spend decades maximizing account balances while completely ignoring how stressful retirement income uncertainty can eventually become emotionally and psychologically. Watching markets fluctuate feels very different once your investments become responsible for paying real monthly bills and healthcare costs consistently. A 20% market decline feels uncomfortable during your working years, but terrifying once retirement income depends heavily upon those investments. That is why dependable cash flow matters emotionally just as much as total portfolio value during retirement planning conversations today. Most people do not actually want to feel wealthy because what they truly want is feeling financially safe and stable. And building that emotional safety often requires a completely different mindset than simply chasing maximum growth inside retirement investment portfolios forever. So before building this portfolio further, think honestly about your own retirement and how many years remain before reaching it. Tax Fund 1, the fund that quietly raises your income over time. The first fund inside this portfolio focuses on something far more important than chasing the biggest dividend yield available today. This fund concentrates on companies with long histories of increasing dividends consistently through different economic cycles and market environments. These are businesses proving they can survive recessions, inflation, uncertainty, and still reward shareholders with larger payments over time. Companies like Microsoft, Coca-Cola, Visa, and Procter& Gamble dominate because their products remain deeply embedded inside everyday American life. People continue buying toothpaste, software, beverages, and household essentials whether the economy feels strong, weak, optimistic, or deeply uncertain. That stability matters enormously during retirement because dependable businesses often create more dependable long-term income streams for investors patiently holding them. This fund does not offer the highest yield today, and that initially disappoints many retirement investors seeking faster monthly income growth. But the real power comes from consistent dividend growth, slowly compounding over decades instead of remaining stagnant year after year endlessly. Think of this fund like a paycheck receiving small raises regularly instead of staying completely frozen for the next 30 years. Those yearly increases may seem insignificant initially, but over time they dramatically strengthen retirement income and purchasing power against rising inflation. Especially because healthcare, insurance, groceries, and housing costs rarely stay the same throughout long retirement periods lasting multiple decades continuously. This fund acts like the stable foundation supporting the rest of the retirement income system built throughout this entire portfolio strategy. Because successful retirement investing often begins with reliability, consistency, and patience rather than excitement, hype, or unrealistic promises of fast wealth. Fund 2, the overlooked sector still paying strong cash flow. The second fund focuses on energy companies, one of the most ignored and misunderstood sectors inside today's modern investment conversations everywhere. Most investors spend their attention chasing artificial intelligence stocks, technology headlines, and whatever exciting story currently dominates financial news cycles online. Meanwhile, many energy companies quietly continue generating enormous cash flow while paying strong dividends to long-term patient shareholders consistently over time. Oil, natural gas, pipelines, and energy infrastructure still power transportation, manufacturing, airline shipping, and large portions of the global economy daily. Even during aggressive technological innovation, the world still depends heavily on reliable energy production supporting everyday economic activity across nearly every industry. That steady demand often allows large energy companies maintaining dependable dividend payments even while other sectors experience volatility or slowing growth periods. Energy stocks may not always deliver explosive growth, but they frequently provide stronger income compared with many traditional growth-focused investment funds. And retirement income investing is not always about excitement, because dependable cash flow often matters more than dramatic short-term stock performance. This section of the portfolio helps strengthen current income while balancing funds primarily designed for long-term dividend, growth, and appreciation later. Sometimes boring industries quietly build life-changing retirement income, while flashy investments receive most attention across social media and financial television coverage. That is why smart retirement portfolios usually include multiple types of investments performing different jobs under different economic conditions throughout retirement years. Because dependable retirement income rarely comes from one perfect investment, and more often comes from balanced systems working together patiently. Fund 3, why smart retirement portfolios don't depend on one country. The third fund expands beyond America because retirement security becomes stronger when investments are diversified across multiple global economies simultaneously. Many American investors unknowingly place nearly their entire financial future inside one country, one market, and one economic system alone. That strategy feels comfortable because American companies dominated global investing conversations for many years through strong growth and technological innovation. But history repeatedly shows that no country leads global markets forever without periods of slower growth, uncertainty, or economic challenges eventually appearing. Japan once looked unstoppable during the 1980s before decades of weak market performance shocked investors relying entirely on domestic investments. International diversification helps reduce the emotional risk of depending completely upon one economy performing perfectly throughout your entire retirement journey ahead. This fund includes thousands of companies spread across Europe, Asia, Canada, emerging markets, and many economies outside the United States entirely. That means retirement income can continue flowing from different regions even when certain countries experience temporary economic weakness or financial instability periods. Many international companies also pay stronger dividends because their business cultures traditionally prioritize shareholder income more consistently than American growth-focused corporations do. That creates an opportunity for retirees seeking both diversification and stronger long-term income growth from outside traditional American investment portfolios today. International investing may occasionally feel slower emotionally because unfamiliar companies rarely receive the same media excitement as major American technology giants. But retirement investing should focus more on resilience and dependable income rather than constantly chasing whatever investment trend feels hottest currently. Because protecting your future often means building a portfolio capable of surviving multiple economic environments instead of depending on one perfect outcome forever. Fund 4, the part of the portfolio built to pay more today, the fourth fund inside this portfolio focuses more aggressively on international companies already paying stronger dividends to investors right now today. Unlike broader international index funds, this one intentionally searches for businesses producing higher current income across global markets and industries consistently. That higher yield helps strengthen immediate retirement cash flow, while other parts of the portfolio continue focusing more heavily upon future growth. Some investments inside retirement portfolios should behave like young trees, slowly growing larger over long periods of time through steady compounding. Other investments should already produce fruit today by helping cover monthly expenses like groceries, insurance premiums, utilities, and healthcare costs immediately. This fund plays that second role by increasing the portfolio's current income without depending entirely upon future dividend growth alone later. Many of these companies operate in industries generating steady cash flow while trading at lower valuations than expensive American growth stocks today. That combination often allows them paying stronger dividends while still maintaining sustainable businesses capable surviving difficult economic periods reasonably well over time. Higher dividend income can become emotionally comforting during retirement because retirees see actual cash arriving, regardless of temporary market fluctuations happening daily. Especially during market downturns when falling portfolio values create fear, dependable dividends can help investors remain calmer and emotionally disciplined longer. This does not eliminate risk completely because every investment still carries uncertainty, volatility, and periods of disappointing performance from time to time. But building multiple income sources inside one portfolio often creates stronger retirement stability compared with depending upon one strategy entirely by itself. Because successful retirement investing usually comes from balance, patience, and realistic expectations instead of searching endlessly for perfect investments or shortcuts. Fund 5, the long-term income engine most investors ignore. The fifth fund focuses on international companies consistently increasing dividends every year instead of simply paying large dividends today alone. This creates a powerful combination because the portfolio now contains both stronger current income and stronger future income growth simultaneously together. Many investors ignore dividend growth completely because slow compounding rarely feels exciting during the early years of building wealth patiently over time. But retirement investing rewards patience far more often than emotional reactions, market predictions, or constantly chasing whatever investment trend feels hottest. A company increasing dividends steadily every year slowly creates larger income streams without investors needing to contribute significantly more additional money later. That matters enormously during retirement because inflation quietly raises living costs while fixed income sources slowly lose purchasing power over many years. A stagnant dividend may feel acceptable initially, but eventually groceries, healthcare, insurance, and housing costs begin growing much faster than income. Dividend growth helps solve that problem by increasing retirement cash flow gradually instead of allowing purchasing power shrinking continuously with inflation pressure. Think about someone retiring today and remaining retired for potentially 30 years, or even longer, depending upon health and life expectancy. The retirement income supporting them today must eventually support a very different economy, filled with much higher prices and expenses later. That is why growing income streams often matter more than simply starting retirement with the highest possible dividend yield immediately available today. Small dividends growing consistently for decades can eventually become surprisingly powerful sources of long-term financial stability and emotional peace of mind. This final fund helps complete the portfolio by strengthening future income growth while balancing stronger current income from other portfolio sections. Together, these five Vanguard funds create a system designed not only for growth, but for dependable retirement income lasting decades potentially. Attach Now, the important question becomes how much income this portfolio could realistically generate after years of consistent disciplined investing and compounding. Fortunately, the math behind this strategy is much simpler than most people expect when first learning about retirement income investing concepts. Each fund inside the portfolio performs a slightly different role, but together they create balanced income, growth, and diversification working simultaneously. Some funds provide stronger dividends today, while others focus more heavily on growing future income faster through long-term dividend increases consistently. When combined evenly, the portfolio creates a blended dividend yield stronger than the S&P 500 by itself alone normally produces. More importantly, the portfolio also includes strong dividend growth, helping retirement income increase gradually alongside inflation and rising living expenses later. That combination matters because retirees need income supporting both present bills and future costs across decades of retirement living realistically. Imagine dividends covering groceries first, then eventually utilities, insurance payments, prescriptions, transportation costs, and other everyday retirement expenses over time. At first, the income may appear small, and that discourages many investors expecting immediate dramatic results from investing consistently every month. But compounding behaves quietly during early years before eventually accelerating much faster once reinvested dividends begin contributing meaningful portfolio growth themselves. Eventually, the portfolio starts generating enough income that investment growth no longer depends entirely upon your personal monthly contributions anymore. That moment changes everything emotionally because your investments slowly begin working harder than your actual paycheck supporting future retirement goals ahead. And this is where many long-term investors finally realize why patience matters so much more than trying predicting short-term market movements. Wealth often grows slowly for years before suddenly appearing much larger once compounding gains begin stacking aggressively upon previous growth repeatedly. That slow, invisible compounding process becomes the foundation supporting nearly every successful long-term retirement portfolio built patiently over multiple decades. Tax So what could this portfolio realistically look like for an ordinary American family investing consistently over the next 30 years patiently? Imagine someone starting with $10,000 already saved and contributing roughly $7 daily into this retirement portfolio consistently. $7 per day sounds surprisingly small because many Americans already spend that amount regularly on coffee, snacks, or convenience purchases. But investing small amounts consistently matters far more than waiting endlessly for perfect timing or suddenly receiving large amounts of extra money. During the first few years, progress feels slow because compounding has not fully begun accelerating portfolio growth and dividend reinvestment yet. That early stage discourages many investors because results appear modest despite disciplined contributions continuing month after month without immediate dramatic financial changes. But long-term investing rarely feels exciting initially because the real power appears later, once time begins multiplying consistent financial habits heavily. Around the middle years, reinvested dividends begin contributing more meaningful growth while the portfolio slowly starts compounding much faster emotionally and financially. This is usually the stage where investors finally realize patience was quietly doing far more work than constant market predictions ever could. Over 30 years, consistent investing combined with dividend growth and appreciation can potentially create life-changing retirement income for ordinary working families. And importantly, this journey does not happen during perfect economic conditions filled only with smooth markets and optimistic financial headlines everywhere constantly. There will likely be recessions, inflation spikes, layoffs, market crashes, political uncertainty, and frightening news creating emotional pressure on investors repeatedly. But historically, the investors continuing steadily through uncertainty often benefit the most once markets eventually recover and compounding resumes accelerating again later. Successful retirement investing usually comes from consistency during uncomfortable periods rather than intelligence during easy optimistic bull markets filled with excitement. Because over long periods of time, discipline quietly outperforms panic far more often than most people emotionally expect when starting investing journeys. Passion. Of course, some people do not want waiting 30 years before building meaningful retirement income capable supporting their future lifestyle comfortably anymore. Maybe retirement already feels closer, or maybe they simply want achieving financial independence sooner while still healthy enough enjoying greater personal freedom. That faster path absolutely exists, but it requires significantly larger contributions and greater financial sacrifice during earlier working years before retirement arrives. Instead of starting smaller, this version begins with a much larger initial investment and higher daily contribution amounts consistently invested over time. The advantage is obvious because compounding starts much stronger immediately instead of spending years slowly building momentum from smaller beginning balances first. Larger contributions also create emotional confidence because investors see visible portfolio progress earlier instead of waiting many years for meaningful financial growth appearing. But the trade-off becomes very important because accelerating retirement goals usually requires sacrificing more spending, comfort, and flexibility during present-day working years. That could mean driving older vehicles longer, delaying luxury purchases, reducing vacations, or prioritizing investing over unnecessary lifestyle inflation and impulse spending. Some people happily accept those sacrifices because retiring earlier feels worth far more than temporary consumer comforts disappearing along the journey financially. Others prefer slower, steady investing because maintaining balance and enjoying life today matters equally alongside preparing carefully for future retirement security later. Neither choice is automatically right or wrong because personal finance ultimately depends upon individual priorities, responsibilities, values, and emotional comfort levels deeply. But one important truth remains consistent because building retirement income faster almost always requires investing significantly more money earlier throughout the process. Speed costs money while patience costs time, and every investor eventually chooses which sacrifice feels more manageable personally over the long term. Tatch at the end of the day, nobody can predict exactly what markets, inflation, interest rates, or the economy will do next. There will always be uncertainty because investing has never been about controlling the future with perfect accuracy or confidence completely. But history continues, showing something surprisingly consistent across generations of investors building wealth patiently through discipline and long term thinking habits. People who continue investing steadily through fear, uncertainty, recessions, and market crashes often build stronger financial futures over long periods, not because they are financial geniuses, but because they stay consistent while others panic emotionally during difficult economic environments and downturns. The goal was never becoming rich enough to impress strangers who probably never think about your financial life anyway afterward. The real goal was creating a life where money causes less fear, stress, and emotional pressure during ordinary everyday moments consistently. A life where groceries feel manageable, bills feel predictable, and retirement no longer feels like a terrifying financial cliff approaching silently. A dependable retirement income stream may not look exciting online, but emotionally it can completely transform someone's future and peace of mind. And honestly, many people watching this video are probably carrying quiet financial fears they rarely discuss openly with anyone around them. So if someone in your life feels stressed about retirement, money, or their future, share this video with them sincerely today. Because one thoughtful conversation about investing, patience, and financial freedom could genuinely help change the direction of someone's entire life forever.